Welcome to Bloomberg Markets. I'm Shonali Bassick. Let's get a check on these markets because it's been a choppy trade this week. But you're watching the S&P 500 now still firmly up about 0.6%. You'd need a little more than that to get out of the slump of this week. Could have the first down week in 7 weeks. This would be the streak breaking 6 weeks in a row of gains. NASDAQ 100, though, would be on its 7th straight week of gains. It's 1.4% higher on the day. The 2-year yield hanging out at 407, and New York crude now at 71. You're having a rise about 2%. Let's take a look at some midday movers on the equity side here. We are in the middle of earnings season, but we also have some M&A news. Boeing, let's take a look at it. The shares are rising. It's reportedly in early talks to sell its space business. That would be an end of an era. It would include Starliner and space station operations, according to the Wall Street Journal, and it would be part of the company's efforts to shore up financing amid supply chain snarls, union strikes, and regulatory scrutiny. But you're only seeing Boeing up around 0.7% now. We're also watching Deckers. This is an earnings story, up 11%. The company behind Hoka and UGG surging after boosting its forecast for the year. Net sales jumped 20% in the previous quarter compared to a year ago. And of course, a story close to my heart, the beat that I follow, financials. New York Community Banks shares are falling, and it's the worst day since early September. The regional lender is providing guidance for net interest income and earnings per share for 2024 and 2025 that came in below Wall Street estimates. And you have New York Community Bank now down more than 7%. We're going to dig into it more with Bloomberg Intelligence senior bank analyst Herman Chan. And it's interesting because you're seeing a lot of sour moods today in the bank stocks. You're seeing the KBW Bank Index and Regional Bank Index, most stocks in the red. Actually, in the bank index, the only one in the green today is Capital One.
Right.
What kind of overhang do you see from New York Community Bank?
Yeah, for New York Community, it is very much a bit more idiosyncratic with their turnaround in their business, de-emphasizing the commercial real estate aspect of what they do, and really pivoting to a commercial and business lending focus. That's going to take a bit more time because they're seeing some weaker credit quality, specifically with their commercial real estate exposure, and that's really taking a big hatchet to their estimates for EPS for the next couple of years.
But something that's incredible to me, that even before today, you saw New York Community Bank down more than 60% this year, and you see it down another 7% today. So why wasn't a lot of this already baked in?
Yeah, the reporting today really demonstrated that the turnaround is going to take a bit more time than previously contemplated.
A lot more time?
Well, they're talking about positive earnings, not next year, but in 2026 potentially. So it's going to be a tough slog for them to really change their business, becoming more commercial focused and still dealing with the credit quality from their legacy commercial real estate exposures.
I can absolutely understand that New York Community Bank had certain idiosyncratic exposures given the rules in New York and whatnot, but how could you be so convinced that more regional banks are not going to fall prey to a greater degree to commercial real estate?
Right. So a couple of things really comes to mind. The exposures to problematic commercial real estate lending, office CRE, for example, it's much lower for the other regional banks that I cover versus the New York Community. Second, the credit quality for commercial lending is still fairly strong, so the other parts of the businesses are still holding up really well. And capital and liquidity is really strong, so there's not much in terms of red flags that really are cautionary in our view.
So when you think about the earnings season so far, do you like what you see when it comes to the regional banking system?
Right. So for the regional banks on a whole, everything was really stable. Net interest income grew about 2% on average. Lending really hasn't been materializing for the regionals, but there's expectation for that to come back as interest rates decline and the Fed cuts interest rates. So there are some positives, but at the end of the day, it's about managing rate risk, and with rates coming down, how do they manage the loans repricing and also the deposit repricing as well?
A lot of questions ahead. That is Herman Chan from Bloomberg Intelligence. We thank you so very much for breaking all of that down for us here on set. We're going to branch out now from the public to the private markets. Of course, the inverse of that regional bank story is what is happening over in private credit. For that, we are joined by Monroe Capital Chairman and CEO Ted Koenig, whose firm had agreed to sell a majority stake to French investment firm Wendel just this week. Ted, you are in the center of one of the hottest trends in the market right now, not just private credit, but the consolidation among private credit managers. Can you just take us back for a minute and talk about this deal process and what got you to this tie-up with another investment firm?
Sure. Thank you very much for having me today. You're right. This has been one of the hottest areas of alternative investments. We've grown our firm at a 25% CAGR since the financial crisis. And a lot of the reason for the growth was a lot of the lending has been pushed out of the regulated financial markets into the non-regulated financial markets to firms like Monroe. We went on a search to find what we thought would be the ideal partner. We wanted someone who was very, very limited partner focused, investor focused, someone who had a significant balance sheet that could help us grow the business, but yet someone who was going to allow us to have investment and operational independence. We found a firm, a 320-year-old firm, French investment firm in Wendel. They've been around since 1720. They've survived 2 revolutions. There's about 1,300 family members, and they agreed to give us and make available $1 billion of seed capital so that we can continue to grow our business and attract more and more institutional investors and high net worth investors into what has become a very, very stable, consistent, and investor-friendly asset class.
So we were talking a little bit about the pressures in the regional banking system. You had talked about, since 2008, a lot of activity has moved into private credit. I'm curious on how that extension works now, because when I had gone around and talked to a lot of folks in this market, they said, the introduction of Basel III endgame could even accelerate that push even more. Do you see it that way?
Yeah, what happened was in the financial crisis, one of the challenges was the regulated banks were stuck. They were holding a tremendous amount of LBO loans that they normally would sell. Once the financial crisis happened, those loans became essentially non-saleable, and the banks needed to be bailed out. The regulators at the time decided we were never going to get into that position again, not only the US regulators, but regulators around the world, and forced all of those buyout loans out of the banking system into the institutional investor market. So when I first started this business, 90% of the lending was in the regulated financial industry. 10% was out. Today, it's exactly the opposite. 90% of the leverage loans, the buyout loans, are held outside the regulated banking industry, and only 10% remains today, and that's not changing. If anything, it's going to continue to move outside the regulated financial institutions.
It's interesting. There was a report, a financial stability report put out a few days ago by the IMF, and they said that when it comes to non-bank financial institutions, private credit in particular, there is a stabilizing force under the surface, but there are also a significant amount of risks, as well as certain recommendations they made, including increasing transparency, expanding data collection, boosting counterparty resilience, among other things. What do you think about those recommendations? How much more transparency does this market really need?
All that is good. Remember, the reason why the loans were moved out of the regulated financial system is because depositors are the ones that bore the brunt of the risk during the financial crisis when the taxpayers had to bail out the banks. Same thing happened in Europe. Same thing happened in Asia. When you move loans outside of the regulated system into the institutional system, we don't have a depositor issue anymore. The interests and the entities that are best able to bear those risks and to hold those assets for the long term are in exactly the right position. The institutional investor market, the pension funds, the insurance companies, the entities that don't have to mark those assets on a quarterly basis and move them out and take losses quickly in the event that the market moves against them. So the regulators did exactly what they should have done And the result actually is the perfect result today. And that's why the private credit business has grown so much,
Ted,
is because the assets are exactly the way they should be.
Ted, you just are coming off of this big deal announcement with Wendel, but does this also give you firepower to look ahead and maybe pursue more deals of your own? Do you see more consolidation in this space, particularly for yourself?
Yeah, there's no doubt about it. We are the largest player in the lower middle market. When I define lower middle market, that's mainstream America. There's 200,000 companies in the US alone that are $250 million in revenues and below. And I've got a strong appetite to continue to grow the firm and consolidate. The smaller firms are going to have much more challenges raising money and doing business as this industry continues to mature and consolidate.
Ted, we thank you so very much for joining us on the heels of that announcement. That is Monroe Capital Chairman and CEO Ted Koenig. Now, coming up, big tech earnings continue next week. Alphabet, Microsoft, Meta, Apple, all reporting. We're going to break down expectations next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. It's time now for the stock of the hour. It's actually the Magnificent 7 ETF we're going to look at today, gaining ahead of big tech earnings next week. Tesla helping boost the basket of stocks on its own earnings. But now we await Alphabet, Microsoft, Meta, Amazon, and Apple earnings all next week. I hope you get some sleep before we are getting into that part of earnings season. We're going to bring in now Bloomberg technology co-host Ed Ludlow, and really a lot to set up for. But really what I'm wondering is how high is the bar for these companies, and which of the companies are most vulnerable to these sky-high expectations?
Yeah, the bar is higher, and it's so interesting because sentiment to the Mag 7 has really changed since the summer. Now, Tesla was a surprise, right? Because it beat expectations in a really big way, and its outlook was one for the bulls. But basically what's happened is that Mag 7 group kind of peaked in July. We know that they were such a contributor to the S&P 500 for the first half of the year, but since July they've fallen away. There are questions of valuation, and the way to look at it is it all comes down to earnings growth. For all of the investment in AI and CapEx, what are they showing in translation to earnings? If you take the four that are going to announce next week, or you strip out Meta and you include NVIDIA, I think earnings growth expectations are less than 20%. But that's still big relative to the index overall. It's just that it's at its slowest rate of growth in about 6 quarters. So things are changing, and the bar is higher as a result.
If the bar is higher, then how are investors going to treat that marginal CapEx spend?
Yeah. I mean, there's just more evidence that the companies are spending and investing even more. For example, Alphabet, its CapEx is tracked so closely because its cloud business is the #3 player in the market behind AWS and Azure. At the same time, it's investing in Waymo. We just covered the Series C this morning. But is it translating to top-line growth and bottom-line growth? The prior quarter showed yes. Google Cloud Platform did provide on that. But again, relative to expectations, will it continue to do so? That's just one example.
I also want to talk about the companies that are more heavily weighted in the Philadelphia Semiconductor Index. We can look at the Mag 7, we can look at the NASDAQ 100, but the SOX is up at 26% this year, and today almost every member of it in the green ahead of next week's earnings, and AMD is Tuesday. What are your expectations?
So there's the big picture, and then there's the idiosyncratic. AMD is benefiting from all the AI investment, right? It offers an AI accelerator that competes with NVIDIA's products. The difference is AMD's much smaller. They might do $4.5 billion of AI chip sales this year, and if they exceed that, great, the market will love it. But the thing that's specific to them is the timeline of their technology. They've come out with the MI300 generation, and what I hear from sources at all kinds of technology companies is AMD's chip is great. The problem is, if you go with it, by the time you've installed it in a data center somewhere, NVIDIA's out with another better chip. And so you have to think about your technology pathway, and AMD's had a tough time of explaining that to investors. They keep saying our chip is so good relative to NVIDIA's. The bigger question is, well, in that case, when's it actually available in the real world for us to use to drive our cloud computing? And there's much to remain in that conversation, for sure.
Ed, we got to leave it there. We thank you so much for your time. Like I said, everybody get some sleep, particularly you. It's a really busy week ahead. That is Bloomberg's Ed Ludlow, co-host of Bloomberg Technology. Now, coming up, we're going to talk to L2 Point. There's a new debut fund out there, and they're looking at the companies that maybe sort of could go public at some point. We're going to talk about what that means next. This is Bloomberg. This is Bloomberg Markets. I'm Sonali Basak, and this week, private equity firm L2 Point announced the close of its inaugural fund with $460 million in capital. But, you know, that money will go a long way as growth capital seeks new investors. We're going to discuss it with managing partner and chief investment officer Kerstin Dittmar, joining me here on set. Before L2, she worked at Sixth Street and started L2 back in 2018. It's an interesting time for you to be doing this because this is kind of hybrid capital you're focused on here. Explain the structuring here and why this has become so much more interesting when you think about growth capital.
Absolutely. Well, thank you for having me today, Sonali. Fundamentally, structured equity is meant to offer growth companies an alternative cost of capital solution that is less dilutive, less costly than traditional growth equity, but also doesn't come with the operational restrictions and lack of upside alignment that traditional debt products offer. The companies that we focus on and we work with at L2 Point tend to be at an inflection point where they actually could be profitable, they could be self-sustaining, but they're seeing this really interesting growth opportunity in front of them, and they want to be able to continue throwing fuel on the fire. Now, they're mindful of the cost of capital, they're mindful of the dilution they might incur with that, and so structured equity actually offers an interesting, as you said, hybrid solution that balances that cost of capital with the operational restriction.
It's very interesting timing to talk about this because the IPO market has been choppy at best, closed in many parts of the market. And in addition to closing the fund, you've also deployed a lot of it already. I mean, what are the opportunities you've been finding as this IPO market has stayed so shut to so many companies?
Absolutely. I mean, the IPO market, even if it were to reopen, is facing a huge backlog of tech companies. If you think about normally about 30 tech companies can go public in a given year, we have a backlog of over 200 companies that are potential IPO candidates. So even with the markets reopening, there's still a large number of companies that need to find private financing solutions to fund their continued investments into growth. And again, they're sensitive to dilution. They want to minimize that. The valuation environment has also reset. We're certainly not at the multiples that we saw in 2020 and 2021. Companies over the last 2 years have really hesitated to raise in that lower valuation environment. But I think today are coming to the conclusion that they want to be able to continue to invest in growth. They want to raise capital, but again, just be mindful of the capital efficiency.
So how does this work exactly? So if the valuation reset has been underway, still happening in many parts of the market, does taking capital from you help them with kind of avoiding a down round situation?
It can. So the way that structured equity is implemented is that we are trading some amount of contractual return element that we receive in exchange for seeking less upside than a traditional growth equity investor might. So that really allows the companies to grow into perhaps that out-of-the-money valuation that they raised at a couple of years ago without locking in that dilution today and giving them a chance to take their high growth rate and get themselves to that point where they need to be in order to raise an up round.
What's the outlook there, right? Because some of that is buying time. It's buying time to hope for that better valuation a little bit later on. At what point do we get there?
Yeah, look, I don't think we're going to go back to the multiples that we saw in 2020 and 2021 anytime soon, if ever. But companies are growing, right? And if you're a company that's growing at 30, 40, 50%, and you are maybe 30, 40, 50% out of the money, over time, you can get yourself there. And if you're confident in that growth, you're willing to take on this effectively form of leverage, but done through an equity instrument, again, that doesn't come with all these operational restrictions, and also with not the cash debt service that you have with a traditional debt product.
There's a lot of conversation about companies getting bigger and bigger and bigger before they go public, huge companies in private markets. So when you go out to companies with a solution like this and they're trying to raise capital, they're trying to make it through this kind of period and time, are they tending to be bigger companies?
They can range. For us, we particularly focus on companies that are anywhere from 40 million plus in revenue. Some of our companies have $800 million plus in revenue. But it's late stage growth companies that are, again, fundamentally at that point where if they needed to be profitable, they could. That varies by industry. So a software company might be able to reach that scale at a lower revenue number. A higher fixed cost company, an e-commerce company might need $100 million plus in revenue to get there. What we're seeing also is companies being very thoughtful about the amount of capital that they're raising. You're not seeing the number of mega rounds that you saw in 2020 and 2021 where capital was pretty cheap. Capital was in some cases free. And the size of the round, you were going to maximize it because of that cost of capital. Today, where there is a much more tangible cost to that capital, especially those late stage growth companies that don't need that much money are being a lot more thoughtful about the size of rounds that they're raising.
We have to leave it there, but it's so great to have you in studio today. Of course, this private market has been of very high interest, particularly with a lot of these IPO markets still so closed. That is L2 Points. Kerstin Dittmar, of course, on a view under the hood and what's around the corner in the world of capital raising. Before we let you go, let's take a look at these markets here because we are back up on the S&P 500. It's been a tough week, but we're ending higher. It looks like the S&P 500 is up about 0.5%, off of session highs, but still high nonetheless. If we keep at this level, still ending on a down week, though. The NASDAQ 100 in a better shape here. We are looking at the NASDAQ 100 up 1.3% this day, and of course up on the week as well. The 2-year yield at 407, roughly flat, and it's been a fascinating move in the bond market. Not so much on the short end, but certainly on the long end. Part of that Trump trade still having a look at around 421 on the 10-year. Bitcoin down about 0.7%. Gold higher, but not by much. These have certainly been the safety trades that have underpinned a market where there's a little bit of fear under the surface. But again, a lot to tell next week for a big week of earnings. I'm Sonali Basak. That does it for Bloomberg Markets. Have a great weekend. This is Bloomberg.